Welcome everybody on the earnings call. I'd like to introduce you to Qtr4, who's the CFO for Max Life. He's joined me as well. And Mr. Jatin Khanna, who handles the investor relations for Max Financial Services. So let me start with the key highlights, and then we can move on to some of the strategic priorities for the group, and then thereafter we would welcome questions from you all. So we've had a pretty solid year, I must say. The revenue growth has been 15%, achieving 14,967 crores. Our consolidated PBT, however, was lower than last year at 538 crores. But then, last year was an unusual year for us when we were in the midst of a merger with HDFC, which you are all familiar. Moving on to some highlights of Max Life specifically. You will recollect that a few quarters back we had shared an aspiration to get to a 20-20-20 performance on embedded value, sales, and margins, and this was to be achieved by 2020. I'm delighted to share that we have achieved this during the year itself. The MCEV has grown by 21% on an operating basis, and so the EV is at 7,509 crores. This is after dividends, right? Yeah, this is after dividends. Value of new business has grown by 31% to 656 crores, with our margins at 20%, and that's an improvement of about 140 basis points over last year. Our individual adjusted sales, that has grown 22% to 3,215 crores, with an undiluted focus on traditional and protection products. We have experienced a strong growth across all our channels, and we are very encouraged by this performance. We continue to focus strongly on digital, and the e-commerce channel has grown 112%. Online ULIP has been launched to gain further market share in the online market. Protection sales, including individual and group, that's grown 35% year on year, resulting in improvement in protection mix from 7% in financial year 17 to 8% in financial year 18. We want to take this to about 11% or so by financial year 21. Gross written premium has grown 16% to 12,501 crores. There's a 15% growth in renewal premiums at 8,152 crores, and this has been led by a record improvement in the conservation ratio to 90%, which is one of the highest in the industry. The trend lines in the expense ratios, conservation, persistency, all continue to show a healthy year-on-year improvement. Claim settlement ratio at 98.3 is probably best in class. Our solvency surplus is at 2,028 crores, with a solvency ratio registering 275%. Assets under management has, for the first time, crossed the 50,000 crore milestone, and now it's at 52,237 crores, growing 18% year on year. Some softer aspects of the business, and these are awards and accolades. Max Life has won the Life Insurer of the Year at the Outlook Money Awards for 2018. And they also won a gold at the ASQ World Conference for Quality and Improvement for the year 2018. Now briefly about the performance highlights for Q4 of 2018. Again, strong performance with a 23% growth in GWP, which is at 4,648 crores. 28% individual adjusted FYP growth to 1,339 crores, and the shareholder profit pre-tax has increased 3% to 225 crores. I'd like to now talk about some of these strategic priorities for Max Life for during the period of what we are envisaging from financial year 19 all the way to 21. And we just concluded our business and strategic review. So, some highlights on that. We will continue our efforts to deeply integrate with our partners and build capabilities across products, marketing, and technology. We will accelerate investment in proprietary channels to build a robust multi-distribution architecture. We will aspire to grow these channels by around 35% CAGR over the next 3 years to get to a more balanced channel mix and get as close to about 35 to 40% contribution from these channels, bring down the Axis to about 40 to 45%, and the others is 15 to 20%. Max Life agency channel is one of the few channels in the country that is delivering positive margins. We will continue to build on our market leadership in online sales because of consistent pricing advantage powered by strong underwriting capabilities. I'd like to now just touch upon the bancassurance strategy. There's a sharp focus to retain and grow our existing partners. There's also a lot of curiosity in terms of the Axis Bank partnership. So here I would just like to say 3 things. And we have a kind of a socialized script between Axis and ourselves, and I've said this on some of my investor meetings as well. Number 1, our arrangement, which is till 2021, that is strong, solid, and sacrosanct. So that's not changing. Number 2, any of these long-term strategic initiatives like Greenfield, Brownfield, we're told is not a priority for the bank at this point in time. And the third thing is that if and when they decide to do something which is strategic in nature, we would be front runners, and this is because of the fact that we have a long-standing, mutually rewarding relationship. So on our side, we are very optimistic that we are a preferred partner, and I'd like to believe that the arrangement which they have with us is far superior to any other option that they may want to explore in the future. In our assessment, the value creation from us is in multiples of any other option. So we will continue to maintain an aggressive posture towards inorganic growth for acquiring bank-based life insurers and acquiring new banker relationships. And to this effect, the Max Financial Board has approved a significant capital raise too. There will be a focus to pursue a more balanced product portfolio with a bias towards preferred segments in which we want to grow. Given our increased focus on the affluent customer segment, you will see a proportion of PAR will reduce to around 40%, contribution from ULIP increasing to about 40%, and protection-focused contribution increasing to about 11% from the current 8%. Having achieved the 20-20-20 target over 3 years within 1 year, we have now set our aspirations to a 25-25-25 target over the next 3 years. The key drivers will be growth acceleration, increased protection focus, and sustained improvement in cost ratios. So to sum up, Max Financial Services is delivering strong performance for shareholders via Max Life, which will further improve as Max Life delivers on its new strategic plan. There is a three-pronged strategy in play for addressing the channel concentration risks that have been playing in the mind of investors. Aggressively grow our proprietary channels, retain and grow existing partners, and pursue inorganic opportunities to balance out the channel mix in a shorter time. On that note, I'd like to hand you back to the moderator and open it up for questions and answers. Thank you.
Thank you very much. We will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Before we take the next question, I would like to remind participants again, if you have a question, you may press star and 1. We take the first question from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah, hi sir, this is Prakhar. Couple of questions. First, when I look at your unwind rate, which has come up by to 9.73 vis-a-vis 9.5, whereas when we look for other players, there has been decline. Anything to read into it, or why we have seen a rise in your unwind and discount rate?
No specific reason. These are minor movements. You may also like to see that our non-hedgeable risk, which typically is higher than the market, we do it at 5%, whereas I've seen that the market players are 3.5 to 4%. So when it unwinds at a higher rate. So, you should expect us to have our unwind rate, higher than the market players because of that reason.
So that probably will continue in future course of years.
Yes, that's correct.
And second is more from a overall perspective. How do you see the overall size of protection market in India? If any ballpark numbers, or how do you see it in Indian context?
Yeah, basically I will give the answer broken into two parts. One is the group market, which to a great extent is protection only if you exclude the funds business, which really is not life insurance, that's fund management business. So if you were to look at the group business, almost all of it is protection, and it has been growing, close to about 15% year on year. So that should continue to build. On individual side, I think the current mix will be in the range of 2 to 3% if you include the entire market, including LIC. And I'm reasonably sure that in a few years from now, that should go closer to 10%, and that by far will be one of the highest margin drivers if a company demonstrates very strong underwriting capabilities, then it will be a strong margin driver. So we are definitely quite bullish on the protection market, and that's reflected in the strategy that Mohit just outlined.
And last question, how many banks have we tied up for in terms of credit protect plans? And related question related to it, there's so much, so there has been commentary from various other players that credit protect business is possibly seeing higher level of competition and thus there's some pricing pressure. Do you also see the same, or probably it's too early to comment?
So we have credit protect business with people who we work closely, but as you may know, credit protect business not only comes from banks but also comes from NBFCs, other financial service providers and loan providers. We currently have the largest relationship is with Axis Bank, but other than that, we have a relationship with 3-4 other NBFCs, and we are in the process of building it. However, a large part of this growth from our current 8% to 11-12% is predicated on individuals. So we will be quite aggressive in the individual business, which is more sustainable, and we believe that it will continue to provide good source of margin as we continue to work through.
Okay, and the second part is that pricing thing. Do you see any pressure on pricing flowing through in credit protect businesses?
Could flow through. I mean, that's really a B2B business, and in B2B business, it is logical that the margin generally gets sucked out as more people jump in the fray, and exactly for the same reason as I described to you, we are going to be more aggressive in the individual business rather than in the credit protect business.
Okay, thank you so much, sir. That was it.
Thank you. Before we take the next question, a reminder to all the participants. If you wish to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Madhukar Ladha from HDFC Securities. Please go ahead.
Hi, sir. Good afternoon. Can you name the sources and quantify the amounts that have caused this improvement?
We are not able to hear you, Madhukar, that well. If you could please come close to the phone.
Excuse me, Mr. Ladha, requesting you to please use the handset mode. Mr. Madhukar Ladha, can you please respond? Hello?
I think dropped off.
Well, as there seems no response from the current participant, we move on to the next question. It is from the line of Utsav Kovadekar from Investor Capital. Please go ahead.
Thanks for the opportunity, sir. Sir, just a couple of questions from my side. If I look at the AUM growth for this year, it has declined compared to our historical run rate. It is now around 18%. Is it because of the decline in markets or higher surrenders? Any specific reasons?
None of that actually. Some bit because of, market being more stable. But none of that. Typically our growth rate will range, between 18 to 20, 22%. And, it completely depends on, how you have written the business, some bit. So no specific reason. We expect it to be in the range of about 18 to 20% going forward.
Okay, and the second question is, just want to understand the distribution from Axis Bank perspective. Like LIC is doing good business with them. So just wanted to understand how the things will span out over the next couple of years from Axis Bank distribution channel. How are we looking at that piece?
So your observation is correct that Axis Bank is another distribution partner that Axis Bank has. What I'd like to inform you is perhaps the segments where we operate, the two of us, is quite different. So while Axis Bank LIC operates more in the segment of lower ticket size or single premium, as you know, we don't operate in those two segments. We have mutually exclusive markets that we're targeting. If you were to look at a percentage of total sales that is going to LIC at this point in time, it is less than 5%, and we hope that it continues to remain or will continue to remain sub 10%. So really from our perspective, we are quite comfortable with how things are, and it is not different from how we had anticipated it to be.
Thank you, sir.
Thank you. Before we take the next question, a reminder to the participants, if you wish to ask a question, please press star and 1 on your touchtone telephone. We take the next question from the line of Madhukar Ladha from HDFC Securities. Please go ahead.
Hi, everyone. Sorry about the last time. Something went wrong with my line. My question is on the margin improvement. Can you name the sources and quantify the different sources of margin improvement?
So basically two big sources. One source is, higher protection. That should be close to about 1/3 of margin enhancement, and the balance 2/3 is on account of a couple of things. Hardening of interest rate, which generally gives a better profile on margins on non-par, and also, a new design or improved design that we came up with within non-par itself. So those are a couple of reasons that should constitute 2/3. So that's really the full margin enhancement.
All right. Congratulations and all the best for the future. Thank you.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, you may press star then 1. Next question is from the line of Shailendra Mundra from Vibha Financial. Please go ahead.
Hello, gentlemen. Congratulations for a great performance. I want to understand a little bit. There have been some press reports that you have been bidding for the IDBI Federal Life Insurance Company, etc. So, could you please throw some light on what kind of financial arrangements you have made in order to acquire any company if it comes your way? Because it's being heavily on the share prices and investor sentiments. So, like to have some clarification, please.
Okay, so I can only comment on the fact that we are one of the bidders who have reached the final round for this particular transaction. You will appreciate that since it is a bid process, there's no way that, I can talk numbers here. At this point in time, we are to meet with IDBI Federal shareholders for what is going to be a final round. We are in the process of working through documentation, and as far as the funding arrangements are concerned, we have tied up the funding. We have managed to get underwritten offers from several banks, but I'm afraid I won't be able to add more color in terms of quantums or what those arrangements are because of the fact that we are in a very, very sensitive stage as far as the bidding is concerned. You'll appreciate that.
Yeah, thank you. So, at least, will it be a mix of debt and equity, only debt or only equity? Any light on that?
So all of the above, including Max Life, including Japanese. So it's all of these options are going to be evaluated at the appropriate time.
Okay. And one last question on the same thing. Does it, if you manage to acquire the company, IDBI Federal Bank, does it give you any advantage in terms of bank assurance channel with those two partners, IDBI and Federal? Or is it part of the deal or what?
Yes, of course. I mean, that's the only reason, we bid. It's for the distribution. Although they have a very clean book, a good book, and it's about, maybe 1/3 our size, but it's a good book. Nothing major came out in diligence. But yes, the whole idea is to enhance the distribution. And, it comes with two big banks. And that's why I think most insurance companies bid for it. To start with, there were 16, down to 8, down to 5, and now down to, I don't know, a couple maybe.
And when is the entire process going to be completed? So when would we know that it's closed?
Closed, it will be, is only after statutory approval. But if you are asking when is a decision going to be made, we are hoping that will happen, sometime in June. We are hoping like that.
Thank you very much, and all the best in the bidding process, please.
Thank you.
Thank you. We take the next question from the line of Bhavesh Jain from Envision Capital. Please go ahead.
So for this year, our claims and other benefit payout growth rate seems to be high versus the turnover, overall revenue. So how do we should see this line item going forward?
Yeah, it's because of the maturity of UL and PAR book as we are maturing. So that is the reason.
Okay. And sir, you said in FY17 there was some one-off in PBT line item. Is it possible to quantify that?
Yeah, basically, the largest item was, an item which happened because of falling interest rates. So we realized all the gains on the shareholder account, and that was close to about 150 odd crores.
Okay. And sir, how do we see this other bank's channel going forward in terms of the growth rate in that particular channel?
We will expect it to be higher than the company growth rate because, some of these channels are growing quite rapidly. So, if you look at, for example, this year, the other category you would have noticed has grown faster than the average company growth rate.
Okay, sir. Thanks a lot and all the best for the future.
Thank you.
Thank you. We take the next question from the line of Neeraj Toshniwal from Emkay Global. Please go ahead.
Hello, sir. So I just wanted to understand on the margin improvement, which you really talked about sometime back. How much of it is sustainable in terms of the 2/3 portion? Because the protection mix, okay, you're improving and you will be improving more. But out of the rest 2/3, I wanted to understand how much it will be repeat business and how do you see that?
We see that as quite sustainable. You heard Mohit just talk about our strategy on going to 25, which means our outlook is that in next 3 to 4 years, our margin should reach close to 25% from the current level of 20%. And that will happen on the back of increased penetration of protection as well as growth, which will start to churn, economies of scale and, better leverage. So those two factors put together should, take our margin up from current level of 20% to around 25%.
Okay, but my question is actually this 2/3. If you can talk about more on that and how much will that repeat? I mean, hardening of interest rate is again, it can change, and where do you see that? I mean,
just to be honest, we will be able to protect that margin because, what happens on a non-par interest rate guaranteed design is that if the interest rates fall, then there is an impact on the margins, but then now there's a flexibility to go ahead and refile the product. So in a way, it will be easy for us to protect the margin irrespective of how the interest rates are moving. And hence, I'm quite comfortable that, the margins on non-par will be where they are.
Okay, and possibly no impact from change of interest rate, or what assumptions we are taking in, I mean, for the interest rate in VNB margin?
We use the FIMDA curve like I have shared in the deck.
Okay. Okay, and on IDBI Federal, what is the EV book they had in FY18?
So those are really confidential pieces of information that will be quite reluctant to share.
Okay.
We are bound by a confidentiality agreement, so we can't be sharing too much information on the asset at this stage.
Okay, and one more thing was like there was a change in your presentation of for the group and individual for the protection biz. So last year it was something like 5%, which has now become 7%.
Basically, this is just to bring it inconsistent with how other people are reporting. We were earlier reporting only on individual basis, but what I found was most of the people are reporting, total protections. We just made sure that we report at a total level. However, we have also given visibility to individual and groups separately. So you will notice that, it gives you a more comprehensive picture of our current protection mix.
Okay, and in terms of your ticket size in protection, are we seeing ticket size improving after, especially in the individual segment, after riders and a lot of things are happening and people are bringing in different kind of products as well?
That's generally an attempt that we work towards. However, it is not the biggest driver of margin.
Okay.
And, it is quite range bound. Typically on average, our numbers will vary between 13 to 15,000 rupee per ticket size.
And last question would be on your cost ratios, which has improved this year a lot in terms of policyholder, 20% of GWP, which you mentioned. Where do we see after investments to be made in the agency channel? So where do we see over the next few years to be consistent or higher?
We absolutely expect it to get better. And just to give you some sense of the agency investment, we are making investments, to ensure that our current channels start to get fillip. But equally, the decisions that we are making around expansion are not hugely fixed cost oriented, so there will be better control on cost. We are also attempting to leverage the current infrastructure as much as possible so that we could sweat our assets better. And hence, in about 3 years' time, we will definitely expect it to be more closer to 10% from the current level of 13%.
10%, basically reducing the cost. Basically, you're seeing reducing the cost structure by.
No, I mean, really, you hold the cost at lower level and you expand. So it happens more out of expansion overtaking the increase in cost.
Okay.
And, my sense is that the numbers will be, between 11 and 12% from the current level 13% if you outlook 2 more years, 3 more years from here on.
Okay. Congratulations again for the very great set of numbers on this thing.
Thank you.
Thank you. We take the next question from the line of Sumit Karyawala from Morgan Stanley. Please go ahead.
Hello. Hi, Prashant.
Hi.
Just 2 questions from my side. One is on the group protection business. Have you shared any breakup between credit life and term?
Sumit, it's in the presentation.
It's there in the presentation, is it?
Yeah.
Okay. So I'll take it from there. And the other one is if you can share the distribution mix for individual protection as well. I am not sure whether it's there in the presentation or not.
So basically, if you look at the credit protect, it is close to about 1%. The individual is close to about 4.2. So between the two, credit protect and individual, will come close to between 5.1 to 5.2. That's where we'll end up. The balance is GTL business.
Yeah. Okay, balance is GTL. Yeah, and the other question was with respect to distribution mix of the individual protection business. So how much is...
So a large part actually of the, of the 5.2% that you see, needless to say, the share from our own channels is reasonably high, will be in the range of about 5 to 6% of their sales being protection. For the bank channels, it ranges between 2 to 3%. So the weighted average comes to about 5.1, 5.2% at a total level. Group credit life, a large part actually comes from Axis Bank.
Okay, and how much of individual protection will be third party web aggregators or something like that? Online web aggregators?
Yeah, it will be close to about 1%, around 1%.
So 1% of overall APE.
So you see, I mentioned to you on individual basis, we are close to about 4.1, 4.2%.
Correct.
Of that, I think internet total channel is about anywhere between 1.5 to 2%. And of that, about 50 to 60% comes out of aggregator.
Okay. Thank you.
Thank you. We take the next question from the line of Aditya Jain from CLSA. Please go ahead.
Hi, good afternoon. This is Prakhar. I wanted to just get a sense on the product strategy between ULIPs and PAR. This year, ULIPs have seen a very strong growth, whereas PAR is, flattish. Margin profiles of these products generally are not very different. So, one, can you discuss it in the context of, is there a thought process around changing the mix towards ULIPs? And what would be the difference in terms of margins on these products?
Basically, we don't declare the margins at product levels, but, margin profiles on PAR are slightly better than margin profiles on unit link. When I say slightly, which means, about 200 to 300 basis point more. We did maintain and we have been telling that, we want to reach higher level of balance in our product mix. And from that objective, even in the last call, we described that when we look at long-term product mix, we will like to be between 35 to 40% PAR, a little over 40% on ULIP, and the balance on non-PAR with a higher orientation towards protection business. And what we did last year was an attempt to align it to our long-term strategy. So we are happy with the current level of product mix. Suffices to say at this point in time that we don't intend to become a player where, ULIP will be 60 or 70% of our product mix. But we want to remain at, in the range of where we are, between 40 to 45% of ULIP.
Thank you.
Thank you. We take the next question from the line of Avinash Singh from SBI Cap Securities. Please go ahead.
Yeah, hi. Good set of numbers. One question on persistency. I mean, we have seen towards a longer tenure persistency continues to improve, but I mean, on 13 months, we are sort of stable at 80%. Now, I mean, realistically, where do you see this persistency evolving, and how much this persistency improvement you expect to contribute towards your ambition 25, that 25% new business margin? What sort of improvement that realistically this persistency improvement can bring into your margins?
The 80% number that you see for 13th month, 80-81% number should go past 85%. So I'm quite hopeful that when we finish this year, we will be in the range of about 80 to 83%. We'll continue to make progress. So suffices to say that in 3 years' time, we should attempt to be north of 85%.
Okay. And a similar sort of improvement, of course, not that same level, but the improvement directionally should be similar over the other tenures, like 25s or 37 or so on.
It just flows, but with every passing year, it just flows and transfer to the next tranche.
Yeah. Okay. Thank you.
Thank you. Before we take the next question, a reminder to the participants. If you have a question, you may press star then 1. Next question is from the line of Miyur Sharma from Edelweiss. Please go ahead.
Hello. First of all, congratulations for your results. So I wanted to ask that since you maintained that you will keep your ULIP targets at 40% distribution mix, so what products do you see as contributing to your growth in future other than the protection business?
So, 40 to 45%, so not just quite 40, between 40 and 45% is the target.
Okay.
Again, tactically, it may go up or go down depending on how the markets are moving, and we will be opportunistic about driving growth. While products do play a role in terms of driving the growth, we are anticipating that the growth will be driven also because of the investments that we are going to make in our own channels, as well as productivity improvement that we see year on year through the bank channels. So a large part of bet on growth is also about expansion of distribution channels.
So in terms of breakup of distribution through banks, so what as of now, what is the distribution mix for different products that you are selling through your banking arms? As you previously mentioned, 2 to 3% are protection sales. So what is the other breakup?
So basically, depending on the bank, it ranges again, not very different from how you see it to a top level, between 45 to 50% of ULIP, about, 10%, closer to 10% on non-par, and then the balance of participating. So they also sell quite a balanced product mix like the entire company sells.
Okay, thank you a lot and best of luck.
Thank you.
Thank you. A reminder to the participants, if you have a question, you may press star and 1. Next question is from the line of Saurabh Dole from Qtr4 Capital. Please go ahead.
Yeah, thanks for taking my question. I just have 2 things to talk to you about. One is on the protection side. Now we have, for the last couple of years, we've seen a consistent improvement in the protection business, in the proportion of the protection business. So I just wanted to know what kind of initiatives have you taken which have led to, this consistent improvement. So that is one. And the second would be related to this acquisition that you are looking at. I understand that you are obviously not in a position to give out the financial details, but were you to say acquire this particular entity and say, for instance, if there was any other entity, would you have plans to sell your own policies, that is max policies, through the channel of this particular acquisition that you would have? And how would you look at cannibalization in that case? Yeah, those are my two questions.
So let's take the first question first. On your question on protection, it is correct that we have been focused on protection business, and if you look at our individual protection, for example, we have grown it quite consistently over last few years, and the objective is to continue to grow. I have given a slide also on looking at the protection in terms of number of policies, how we have grown over last 3 years, and all of them are witnessing strong growth. The reason for that growth is two or threefold. A, our focus on e-commerce as a channel and our prowess on working with the digital companies, aggregators, etc., has been one of the core reasons. The second one is having or created competitive product offers which have been accepted by the market, and we continue to do very well there. And number three is aligning the protection penetration as a part of key measurement criteria for evaluation of performance. So starting from the top management to the last person or who does the sale, everybody is aligned in terms of goals and objectives to drive the protection up. So those are two or three reasons why you see enhancement in our protection mix, and we continue to do so, as Mohit explained. On your question on whether or not we will be selling max policies through the distribution partners of the acquired entity, the answer to that is yes, that's the design. However, we will try to ensure that there is good phasing and there is good staging which is provided before we start to do that. If we were to acquire this and we succeed in our bidding process and we happen to acquire, then there will be very detailed plan that we will lay out to start to put distribution and usage of distribution as a part of this acquisition strategy. I didn't quite get your question on being sales replacement, etc. It's just that currently the banking partners are selling the products of that particular life insurance company. When that life insurance company merges with our company, then the distribution partners will continue to sell the products, just being replaced by maybe a brand, etc. But we anticipate that it will be quite seamless, and we don't anticipate any replacement.
Okay. And just one last question on persistency. Now, this is something that is common to almost all life insurance companies. So, on the 13-month persistency, if you look at, so the best players are maybe at around 85%, you are at 80%, and you obviously plan to move to 85%. I just want to understand what industry characteristics drive a 15 percentage point or a, say, 20 percentage point drop in the first bucket, while the successive buckets have around 7 to 8 percentage point kind of a drop.
So basically, this is quite unique about India. If you were to look at more evolved, geographies, generally the persistency will be upwards of 90%. Even in our internet channels, we are witnessing a persistency level of closer to 95%. There are a couple of reasons that drive persistency or lapsation. One of them is the quality of sales, and B, the ticket size. So, the lower is the ticket size, the lower generally is the persistency. And the better quality of representation, the better is the persistency. Also, we have noticed that because of the lock-in which is there for 5 years in ULIP designs, and by virtue of ULIP being higher ticket size products, generally the average ticket size on ULIP will be higher than average ticket size on any other product design. ULIP is witnessing higher persistency for first 4 or 5 years.
Okay. Thank you so much.
Thank you. A reminder to the participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Well, that seemed to be the last question. I would now like to hand the floor over to Mr. Mohit Talwar for his closing comments.
Thank you. I'd like to thank all the participants for sparing time off to be on this call. And we'll have more such calls in the future as well. Thank you very much for taking time off. Goodbye.